Hello, hello, hello. What's going on, everybody? Chat, give me a push if you can hear me in the chat, please. You guys like that? Hold on, can you guys hear me? Yes, sir. Thank you, John. Always a pleasure, everybody. You guys like that hype up video? It really appeals to the Joshes in the world. I'm totally against buying fancy cars and all that shit. I think it's a waste of money. I truly like that saying, you should be rich and not look rich. But Josh likes looking rich. He's broke. He's in college. All right, everybody, welcome to the Max Options Trading Beginner course. What you're going to need today is some pen and paper. Let me get my pen out. Let me get my pen out for everyone. Should I use a new color today? You know what? I'm feeling freaky today. Oh, God, no, I got to use the red. Sorry, I can't do it. You're going to need some pen and paper for today's class, empty notebook, whether you're on phone, laptop, PC, or tablet, some room for some pushies. All right, last week we had a great week. We went over tools, brokers, introductions, candles, support, and resistance, which last Tuesday and Wednesday, this is part of TA, which we're going to learn today. So if you were there for last Tuesday, Wednesday, that's your introduction to technical analysis. And then we learned about all the Greeks, implied volatility, choosing the right contracts. We all had a great weekend, which went extremely fast, but we're back. We're back at it Monday. The technical analysis basics, which is going to lead you into tomorrow, where I teach you my day and swing trading strategies, the difference between them, how to standardize them, and how to start being a confident trader. All right. Classroom rules. Thank you for those who are early and discuss with your classmates about today. At the chat's always fun prior to class. Find a nice quiet place free of distractions. Josh, be respectful at all times. Stay on mute. If you have any questions at any time during this session, please write them down and wait till the end of class. I promise you we will not leave this session without answering all of your questions. Stay focused, stay on task, and some foul language will be used during this class. It is an adult setting. I used to work in a prison for almost 4 years. I worked in the military for almost 6 years. Give me a break, all right? I'm not a fucking angel, but I try my hardest. Before we begin, make sure you guys are following me on Max Options Trade on Twitter. On Instagram, when you're taking this course, go ahead and tag the big account with a screenshot. This one right here will probably do best. And we'll tag you right back. Get you some clout, no matter when you're taking the course, because these are recorded sessions. Follow me on TikTok at Max Options Trading with 2 G's. Unfortunately, we were unable to get the 1 G. The funny thing about TikTok, now that I moved to Italy, is that I am completely curated to Italian TikTok. So I really haven't been enjoying it the last couple weeks, but I'm getting used to some Russian humor. It's fantastic. For some live updates, we post some updates and technical news on Reddit. And then for our YouTube channel, where everything will be recorded, all the classes from now on, do not forget to push that like and subscribe button. Technical analysis. Before we begin, let me get a sip of bubble water. Hope you guys all had a great day today. I closed at about 5,000 for the day, actually. Nice little pump at the end. Got my growth stocks, a little movement. So just under 5K for the day. Not a bad day. I'd like to push it to about 15 for the week. All right. That is delicious. It's called Fazzante Blue. Some good Italian bubble water. All right, this class is one of the longer sessions, so let's just dig right in. What the hell is technical analysis? That's how you should start every class right there. For starters, we're going to save time. We're going to call it TA, all right? TA is a trading tool employed to evaluate securities and attempt to forecast their future movements by analyzing statistics gathered from trading activities such as price movement and volume. All right, unlike FA, fundamental analysis, who attempt to evaluate a security's intrinsic value, technical analysts focus on charts of price movements and various analytical tools to evaluate a security's strength or weaknesses. All right. Over the years, numerous technical indicators, you could find millions, have been developed by analysts that attempt to accurately forecast future price movements. But indicators are just little pieces of a great puzzle. You should never rely completely on one indicator. Some indicators focus primarily on identifying current market trends, support and resistance. Others focus on strength, volume, likelihoods of continuation. Commonly used technical indicators include trend lines, moving averages, momentum indicators, which we're going to go over some of them here with you guys. Patterns are the distinctive formations created by the movements of a security's price on a chart and are the foundation of technical analysis. So you definitely know we're going over some patterns today. Pattern is identified by a line that connects common price points, such as closing price highs or lows during a specific period of time. Technical analysts can use chartists can seek to identify these patterns as a way to anticipate future direction of a security's price. These patterns can be as simple as two little trend lines and complex as a double head and shoulder. Okay, we're going to go over these together. Candlestick and support and resistance. Just a quick recap. If you had missed last Tuesday and Wednesday's class, candlestick patterns, which are TA tools, have been used for centuries to predict price direction. There's various candlesticks patterns used to determine price direction and momentum, including the three-line strike, two black gapping, three black crows, evening stars, abandoned babies. We'll go over all of those. However, it's worth noting that many signals emitted by these candlestick patterns might not work reliably in the modern electronic algorithmic environment, but we're still going to use them. Trend lines indicate the best fit of all data in a single line or curve. A single trend line can be applied to a chart to give a clearer picture of the trend, and trend lines can be applied to the highs and the lows to create a channel. All right, the next period being analyzed and the exact points used to create trend line vary from trader to trader. So you and I, we might not have the same trend lines. We may be looking at the same trend, but our trend lines may differ a little bit. That's okay. It's a zone. Remember, it's a zone. Let's talk about continuation patterns. The continuation patterns suggest that the price will continue to move in the same direction after a continuation pattern completes as it did prior. There's several continuation patterns that technical analysts use to signal the price may continue on the trend. We're going to go over triangles, pennants, and flags. All right, triangles, pennants, and flags, everyone. Bonus for a 5 push-up coupon. Does anyone know what this is prior to starting? Does anyone know what this continuation pattern is right here? It's pretty simple. Does anyone know? I'll give you a hint. It's one of these three, A, B, or C. Does anyone know? Let's see what we got, chat. Somebody better wake the fuck up. You better answer this. Ivan D with the flag. Thank you, Ivan D. You get a 5 push-up coupon. Everybody else, you should be dropping and give them 5. Sorry, Ben. You're too late. I'm sorry, Ben. Everyone else do push-ups. Let's talk about triangles. All right. This occurs when the price action in a security becomes more compressed. There's 3 types of triangles. We have an ascending, which is formed by a rising swing, lows creating an ascending line when they are connected. All right. We have a descending triangle. If you guys are going to write this down, write down ascending, descending, and symmetrical triangles right there. All right. A descending is the swing highs are declining, forming a downward sloping trend line when they are connected. And a symmetrical triangle has a descending swing highs and an ascending swing lows. All right. This will create a symmetrical. I know what you guys are thinking. What the hell is he talking about? So as usual, let me show you because this makes sense. So for the ascending, you can see we have a top resistance line that's pretty flat, and we have a closing in support line. This is a continuation pattern that shows that bullish momentum may continue. All right. If you're entering on an ascending triangle, you would enter on the break of resistance here, and the break back in would be your stop loss essentially, or the bottom could be your stop loss. For a descending, you'll know that resistance is compressing while the support line holds flat. Your entry would be the break of support here, and your stop loss would be a break back in or a break back to test the top of the compression line there. And for a symmetrical triangle, you'll see that we have 2 compressions on the support and resistance, and is backing around in there. It's just bouncing around, up, down, and we break to the top side. So this means we have a bullish continuation. And then this would be your entry, and your stop loss would be a break back in and a test. That's how you would play triangles, all right? And as always, let's head on over to our charting software and see if we can't find any, chat. Let's see if somebody can beat me to finding a triangle. See if someone can find me beating an ascending, descending triangle. I'm going to load my charts real quick because I got some saves. Let's see what we got here, chat. You're risking 10 push-ups for this, by the way. Look at the S&P 500. 12 green days in a row. Absolutely parabolic. And tomorrow it's looking like we're going to gap up with some bullish Amazon news. All right, let's take a look here. Let's see if I can find some triangles before you guys. Holy shit. What is this right here? Chat, someone tell me what kind of triangle I'm looking at right here. This looks like AT&T on the daily. Without going back, which one is this? Is this ascending or descending? You can see right here. This is the whole thing that we're looking for here. All right. We have our bottom support line, pretty flat, which it broke, but it didn't hold. You see that? Didn't hold. That's not a confirmation break. Where the hell are my arrows at? Somebody tell me where my fucking arrows are. Okay, here they are. So you know, the first thing we notice is that we broke into this pattern. All right. We compressed at the top. It bounced around, right? It held, broke out, but didn't confirm. Broke down, but didn't confirm. Broke out with a massive gap out and did confirm. Does everyone see that? So our entry would have been, where the hell's it? On this candle here. This one is your entry candle. And then the continuation pattern goes to the top. That's how it works right there. Our stop loss would have been a break back in at any point to this down here. That's why I was saying that it looked a little hard to say on there. Or if it breaks back to this support level, you could jump back in or out. That's how we do it. Boeing 4-hour ascending triangle. All right, I'm going to put you to it. I'm going to put you to it. Does everybody see this one here? You see how that perfectly plays out in ascending triangle with the breakout, the bounce around, the compressing resistance with the support line. I got BA up here. You said the 4H? Okay. Okay. Where am I looking at right now? I see a downtrend. I don't see, I see a compressing resistance here. Even if we went high wick, no, I'm not really liking it. I'm not seeing it. I'm not seeing a symmetrical there. I mean, maybe a tiny bit, but that is definitely not a ascending. Josh, yeah, go ahead and drop and give me 10 push-ups, Josh. That is incorrect. I mean, I could draw it out like this to be a symmetrical, but we have a break above, we have a breakdown. So, I mean, this could be a symmetrical. If it tests this 100 EMA in the bottom here and then explodes outward somewhere over here, yeah, then this would be a great symmetrical breakout, possibly, but it's definitely not an ascending. Go ahead and drop and give me 10. But AT&T was a great example of an ascending. I hope you guys all got to take a good look at this and see how that's exactly how we can play it. And I hope you all have the basics set up on your trading view. All right, we're going to continue. Let's talk about pennants. So a pennant, which are similar to, I don't know why I just drew that S, by the way. If you guys saw that, this might be some sort of nervous twits or Tourette's, possibly, that S that I just drew. It's honestly, some things I do blow my mind. All right, focus. Pennants, which are similar to flags in terms of structure, have converging trend lines during their consolidation period and last from 1 to 3 weeks. All right, think about that. From 1 to 3 weeks. So we're most likely going to be looking at the daily chart for this kind of pattern, right? The volume at each period of the pennant is also important. This is what separates pennants from triangles and flags. The volume is part of the pattern. The initial move must be met with large volume, while the pennant should have weakening volume, followed by a large increase in volume during the breakout. That's the difference. So you can see, hey, they're just symmetrical triangles. Well, the difference is they're met with large volume. You can see, so that they exaggerate these breakout points because pennants have a huge breakout. So they're very, very good. They look just like flags. So don't get confused. They're only symmetrical with compressing resistance and support, and their continuation patterns met here with large volume. And just like the pennant and just like the flag, you play the breakout of the pennant. Unless you're a scalper, then you could play inside. You play the breakout of the pennant. And the thing that we're looking for is that large volume. So you would enter on the breakout. Stop loss would be coming back into the pennant or a rejection. You play the breakout. Stop loss would be the rejection. All right. So let's head on over to our charting software real quick and find a pennant. Now the difference between this, see, this is a ascending triangle, because when we get back to this daily chart here, you could see that the volume was pretty good, but there was no significant volume there. Nothing really to write home about. So let's see if we can find one that has significant volume. So let's take a look here at NVIDIA. All right. This is NVIDIA compressing down on both sides. All right. This could be a flag. It's got a huge, huge buildup. But the thing that separates this one is the massive spike in volume here on the break to the downside. Does everyone see how it breaks the flag here, or the pennant here on the downside? Now take a look at the bottom here. This volume right here is what the difference is. Now that break to the downside was met with massive, massive volume that led to a sell-off of 16%, or if you just played this candle in the break, 12% on NVIDIA. That's huge loss. All right, so that's the difference. That's what's going to really separate. And obviously, you can see what happened with NVIDIA since, of course, in the news today. But that's the difference between the flag, the pennant, and the triangle. What makes the pennant different is that this volume is going to be absolutely massive. Even if you played the bottom of it here, this breakout, and today's news, massive volume there, which is, I know it's not, but that's what we're looking for. Nothing good over here. No good volume on this one. That's why it's a little bit different. Did anybody find any pennants, or you're not going to risk it? Not risking it this time? All right, let's talk about flags. All right, moving on. Flags, another continuation pattern. This is a pattern of tight consolidation and price action showing a counter trend move that follows directly after a sharp directional movement. The pattern typically consists of 5 to 20 price bars. Now, price bars is going to be based upon the time frame that you are looking at. So intraday, you might be on the 5-minute or 15-minute. If you're a swing trader, you might be looking at the 4-hour or the daily. Flag patterns can be either upward or downward trending. The bottom of the flag should not exceed the midpoint of the flagpole. All right, that is the most important thing to remember. Once you go past the 50-yard line of that flagpole, you no longer have a flag. Flag patterns have 5 main characteristics: the preceding trend, the consolidation channel, the volume pattern, which would be up, 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 down, down, flat, and then the breakout, which you'd see the big volume breakout as well, and a confirmation where price moves in the same direction of the breakout. That's what we're looking for when we're looking for our flag patterns. So for a bear flag, you'll notice we have the initial, we have the consolidation, we have the breakout, and I'm sure somewhere down here on your trading view, you have a large volume pattern. All right, you would enter on the breakout of the flag. Your stop loss would be the top or the break back in if you're high speed. And then same thing on a bull flag. You play the breakout of the consolidation line. You notice on both of these, the bottom of the flag is above the 50-yard line of the flagpole. And our stop loss would be the bottom, or if you're a tight player like me, you would play a stop loss right here, breaking back into the consolidation zone. And that's flags. So this is what separates the 3 of the continuation patterns. The flags, we don't cross that 50-yard line, and we have a reverse consolidation period. So let's head on over to our charting software and find a flag, chat. Somebody find me a flag. All right, I've been doing a lot of the work tonight. I got to tell you, I'm doing a lot of the work. I'm starting to feel a little abused here. Let me find a flag. Now look at Zoom on the daily. Looks like, let's see if we could draw out a flag here for everyone. Let's see, we've been looking at some previous TA I have. Let's see if we can quickly draw out a flag here. All right. This is how I would take my top trend. And the bottom here, I'd probably just snag you. Okay. Now let's see, do we have a run up? Oh shit. What do you guys think? Think we got a flag here? We got an initial. We got the reverse pattern here, just to make it look better. We got the reversal. Let's take a look at the volume. Oh yeah, the huge volume with a steady decline of flat volume. Now the only thing to wait for would be Zoom to break out of this consolidation period at any point here. And then that would be your entrance. And your exit would be back into the consolidation zone or the bottom of the flag. If you're playing on a much smaller time frame, I would highly suggest taking the top one. If you're not playing, if you're in a 5 or 15 minute, I would suggest waiting till it's back in the consolidation zone. So for you day traders, let's see if we can find a flag on something intraday. Let's find an intraday flag, chat. Somebody find me an intraday bull or bear flag breakout. Should be able to eyeball one pretty quickly. Tesla was flagging pretty good today. Let's take a look at Tesla right here. Right? Let's see if we can. So we got a pretty nice uptrend. Let's see if we can draw a Tesla flag. I'll just draw that one out. Little Tesla flag. Now let's take a look just to measure from the top to the bottom here. We got 4.5%, 10 bars, 4.5%. So halfway, if you look at the blue line, the halfway blue line mark right there on the 690, you can see that it didn't even come close to the halfway mark. So you play the breakout right here of this flag. Let's take a look at the volume profile on it. Not too great, not too great, but if you were to play a consolidation breakout like this, you would enter on this candle. The continuation would bring you up to about 703 intraday, and then you could hold it until it was back in this consolidation period. At any point would be your stop loss. And that's what we're looking for the flags. The major difference is that we're not crossing that 50-yard line here at that 690. So we didn't even come close. So you see that? That's the big difference, which is going to separate our continuation patterns right there. You guys are sleeping on me tonight. I didn't get one example on the last two. All right, I'm going to continue reading to you, but you need to wake the hell up. The major drawback to trading continuation patterns, this is the major drawback in chart patterns in general, is false breakouts. Right, false breakout occurs when the price moves outside the pattern, but then moves right back inside the other side. This is why stop losses are used to control risk. When trading a continuation, consider the strength in the price move of the pattern forming. So let me just show you a great example of this real quick, was that NVIDIA play. So there was a massive false breakout on NVIDIA, which you see here, it originally broke out to the upside on the 8th of February, but right by the 24th, 2 weeks later, which you could have taken massive gains on this, it broke down hard right to the downside. So this would be considered a massive false breakout. So went up heavy, didn't have great volume. Volume picked up massively, and the sellers took major control of that pattern. And then that's what we're looking for, is these large volume profiles. You see the difference there? So that's a good way to determine a false breakout, is checking the volume profile on your breakout pattern. When trading a continuation, consider the strength of the price move prior to the pattern forming. Strong moves tend to be more reliable than if the pattern occurred after a weak move or a missed choppy trading. The continuation pattern should be a relatively small part of the prior trending wave, right? That's very important to remember. Many traders look for increasing volume when the price breaks out of the continuation pattern. If there's little volume on a breakout, there's greater likelihood that that breakout will fail. So check your volume profiles when we're looking for that breakout. Okay, let's talk about gap trading real quick. In volatile markets, traders can benefit from large jump in asset prices. They can be turned into big opportunities. So gaps are areas on charts where the price of a stock moves sharply up or down with little to no trading in between. As a result, the assets chart shows a gap in the normal price chart. You'll see it. There's a couple ways to play this, playing the gap, all right? To take advantage of a gap trade, some traders will buy when fundamental or technical factors favor a gap on the next trading day. For example, if you buy a stock after hours when positive earning reports are released, so NVIDIA, Tesla today, Amazon, they're all running big time right now after hours. Some large equity blocks may come in after hours for the gap up. Some traders will short gaps or fade a gap, it's called, in the opposite direction when the high or low point has been determined with technical analysis. So, for example, if the stock gaps up on some speculative report, experienced traders may short it. Lastly, traders may buy when the price level reaches the prior support after the gap has been filled. So once a gap is filled, you may use that as a support level to jump back in for going long or calls. So once a stock has started to fill the gap, this is some real important thing to remember. It rarely stops. So once a stock fills the gap or tests the gap fill, very rarely will it not fill that gap completely. There's no immediate support there or anything to hold it. So it normally goes right back to the next level, which would be the gap fill. The gap and go is when the gap fills TA predict the price moving in two different directions. There's a gap fill and a gap and go. So be sure you correctly classify the gap you're going to play, whether it be the gap and go or the gap fill. I'm going to show you guys both of these. If your gap fails to make new highs by 10 a.m. and volume is low, you could play the short, play the fade, saying that this gap's most likely going to be tested and filled because there's just no volume on the breakout. Okay, so if you see the gap here, this is the gap and go, I call it, or the breakaway gap. What you're looking at is the gap in the chart. And then this would probably be like 10 a.m. over here would be that we made new highs. So it's a very bullish pattern to show that we're probably not going to go back in and fill this gap or test this gap. But you can see here, it was tested right here, but it failed to break back in. This level of support is very bullish. Very, very bullish pattern right here, not breaking back into the gap level, which led to a continuation upward where we had another gap up day. This gap up day, you see how it low volume, didn't make new highs, came right back down and filled the gap. This gap fill, this fade right here, you could have played this gap and gap fill or this gap and go. Two major ways to fill it, but the most important thing is these are new levels of support and resistance since there's nothing prior. So this here, this box becomes a support level now, and this box automatically becomes a support level now. And that's something you can take a big time advantage of on your charts and map out. It takes all of 5 seconds, but we're going to head over there right now anyway and look for gaps. All right. I'm going to show you one that you should all have on your charts right now as active traders. Let's go right here. I just use the purple rectangles for mine. So here's an example of a gap and go. Let's look at SPY on the daily. Let's look at SPY on the 15. It doesn't fucking matter. Look at this massive hole in the charting software. Does everyone see that? Everyone see that? So right there, we have a huge gap. And then by 10 a.m. the next day, well, right now, it looks like we're about 5-6 days in. We just have a consistent, very strong uptrend on the S&P 500 with a gap below. Okay, gaps can take time to fill. Let's take a look at this little gap here. See, we gapped up, and then by 10 a.m. the next day, we had a massive run up. So very bullish. And it didn't even come down to test. We gapped up again right here. This is how I draw my gaps. This is how you guys could do it. I simply come over here to the rectangle tool. I find the top, the body of that candle and the body of this candle. I don't use the shadows as much, or the wicks, as much as I use the bodies. So let's keep going. You can see that candle was tested. Boom. So let's go to about right here. So you can see two examples here. We had a gap up and go. Then we had a gap and fade, but you see how it broke in and was unable to fill the gap. That's very bullish. Remember I told you that? And it pops right back up. Now this gap was created on 11 March and that gap below on 19 March. So it took over a week to come back down, but eventually that gap was filled on the 19th of March completely. And now this gap, once it's filled completely, there's no reason to keep track of it except for that S&R level that was just created. This gap was created on the 8th of March, but didn't get filled till the 25th. All right, so 17 days later, 2.5 weeks later, we finally have a gap fill, but that's why I keep it there, just so you could see, wow, this one took almost 2.5 weeks to fill, but there's a good, strong chance that it will happen. Now we have this one up here. I don't plan on leaving this rectangle here forever, but once it fills, I'm going to keep it there for a while as a major support resistance level. And that's how it takes 5 seconds to draw a gap. You can't do them on Heikinashi candles that we had gone over, but on regular candle price chart action, on any freaking play, you can find these gaps. Look at the size of this one on the 15-minute. So let's just say there's the gap up. And you can see that Tesla didn't fill the gap because the 200 EMA held it up on that bullish news today. So Tesla still has a gap to fill down by the 661, 600 level. It may never fill. That's a possibility, but it's important to keep these key levels drawn out for your technical analysis since it takes all of 5 seconds to do. Let's move on. Let's talk about reversal patterns. All right. A reversal pattern is simply a change in the direction of a stock's price trend. The price highs and lows following the reversal would be lower than the highs and lows before it. Common sense. A reversal pattern speaks for itself. All right. This can also occur at the end of a downtrend if a stock's price begins steadily rising and producing higher highs. So let's talk about double tops and double bottoms. Double tops and double bottoms are chart patterns that occur when an underlying investment moves in a similar pattern to the letter W, which is a double bottom, or an M, which is a double top. Shoo! That shit was nice. You saw that? Those are crispy. The double top is formed when two consecutive rounding tops form the U pattern. Rounding tops can often be an indicator for a bearish reversal, as they often occur after an extended bullish rally. Double bottom patterns are essentially the opposite. A double bottom is formed when a single rounding bottom pattern, which can also be the first sign of a potential reversal. So let's take a look at these. And another thing that's very important to know is these necklines here. All right, so a double bottom, we have one key level, broken neck. We came up to the middle, we tested, we failed, and we broke back down. Now, when you get good at technical analysis, you'll start recognizing, I call it the 3/4. So you'll recognize this part, the second leg, as a potential. So if you're a badass, you could enter your lotto at this point here. If you see the breakup and the check sign with the third or fourth portion, you can use that. But a true entry on a double bottom or double top is the break of the neckline. That's why the neckline is important. A break of the neckline is your entry, and a break back below would be your stop loss for a false breakout or low volume, or simply it just never happened. That would be your entry, would be a break above the neckline and a break below. Don't worry about this right here. You say, oh, I'm missing out on so much. Like I said, when you get really good at it, you can scale up and if it breaks, or you can use that as a stop loss if it's a false breakout. I'm going to show you this on the charts. Double top is the same exact thing. So you have your uptrend hits resistance, hits support level, hits resistance again. Now, if you're getting good at this, a badass would be able to make entry here, saying, oh, this is playing out a double top. I'm going to go ahead and make an enter. It's most likely going to test that neckline and get you some value right here. However, the real way to play it is to play the break of the neckline and using the entry back into the neckline as a stop loss. All right, so that's how you would play a double top and double bottom appropriately. But once you get good at these, you'll be able to snag a little bit of additional value there. So let's head on over to our charting software real quick. I got you guys on this one. You've been a little lazy tonight, but I got you guys on this one. Where is Fastly? All right, let's take a look at Fastly. So we're going to go to the 4 hour for this one to get a clear view. So, oh, I'm sorry. This is Head and Shoulders I'm looking at. Okay, we need to talk double tops. I lied, chat. Get your asses to work. Who's got a double top for me? Let's see what we got here. Actually, I think the S&P 500, that was a good one. What was that? Let's find the this right here is a perfect looking W. This is Nexter Energy, my favorite stock, long-term hold. Now, it's not perfect. However, it is pretty damn clear that this W formation played out strong. All right. So we have leg down, we have the neckline here, we have the leg down, and then if you notice, it actually gapped up above the neckline and continuation. That's very bullish for a double bottom. So we have the W pattern. Remember, on these candlesticks, it's not always going to look as pretty as you want it to. Maybe a little Heikinashi will clear it up for us. You see that? But that's a perfect double bottom play out. Like I said, a badass upon recognition would say, oh, yeah, that's a double bottom. I'm entering here. But the true way to enter would be to wait for that neckline to break right here and use that as your entrance and stop loss. That's the appropriate way to do it. Once we learn a little bit more, you'll see why this. I bet when you'll fine tune your toolkit, you'll be able to make entries on here. That's a double bottom right there, perfectly. PLTR planner. Raza, give me a time frame on planner. I'm a big Palantir Technologies guy myself. Let's see what we got here. Oh yeah, look at that, smack dead right in the middle of my screen. So this is perfect. You see we have the rise up. We got a neckline down. We got our third shoulder. We got our third fourths, I call it, 3/4 right there. And so a badass, when you get better at this, that would be your entry with a stop. However, you find the neckline and your real entry is right here. You get a coupon, by the way, for a 5 push-ups coupon. That was a nice find. Nice double top right there. Perfect entry. One of the big double bottoms that I played on the S&P 500 netted me about $17,000 back when it was bouncing around the 320s here. There it is. Look at this massive bad boy. You see this double bottom? I played this double bottom very heavily on the S&P 500 once it broke back into my trend line. Right here, I entered about 330. I think I cashed out, was like 358. Yeah, it was this big green candle. It was a fantastic trade. So just like that, that's the easiest way to use it. I didn't wait for the neckline because the neckline would have netted me only $5 of intrinsic when I entered above the break of this trend line using just pieces of the puzzle that I told you. It's all pieces of the puzzle, putting it together, making an educated decision. And that educated decision came out very profitable for me. That's all you can do. Now we'll talk about the head and shoulders and the inverse head and shoulders. All right, head and shoulder patterns form when a stock's price tends to peak and subsequently declines back to the base of the prior up move. Then the price rises above the former peak to form the nose, then again declines back down to the original base. Finally, the stock price rises again, but to the level of the first initial peak, forming before declining back down the base of your neckline. An inverse head and shoulder pattern is also a reliable indicator, which can also signal that a downtrend is about to reverse into an upward trend. In this case, the stock's price reaches 3 consecutive lows separated by temporary rallies. The final rally of the third dip signals that the bearish trend has reversed and the prices are likely to keep rallying upward. Listen, I didn't write this dry shit. I just copy all like 95% of this for you guys because I could break it down and I could show you these pictures. Look at this head and shoulders right here. So this is your breakout pattern. Smooth and silky, baby. Look at this. I love this one. I love this joke so much. Here's your head and shoulders here. I'm kidding. Do push-ups, everybody. Everybody do push-ups. So this is what we're looking at. We're looking at the left shoulder, the neckline, the head, the neckline, and the right shoulder. So your breakout and trend reversal point would be the break of the neckline again on the right shoulder for head and shoulders, because this is a reversal pattern. So that uptrend's done for. We're going back down. Right, head and shoulders and inverse head and shoulders is one of the most common formation patterns that you'll see on charts, and they're very, very good. Most of the time, not all the time, because they're just a piece. They work out. So that would be your entry, and then of course, breaking back into the neckline would be your stop loss. Conversely, the left shoulder forms with our neckline. We get a big head down here, neckline, right shoulder. A badass trader, once you get real good at this, you'll see this formation say, okay, 3/4 rule. It's most likely going to play out at head and shoulders, and I'm going to scalp it back to the neckline. You may be wrong, which your stop loss would be here, but if you play it out the way it's supposed to be, you would enter the break of the neckline, and your stop loss would be, of course, breaking back into the neckline. These patterns are very common. Chat, someone better find me a fucking head and shoulders or an inverse while we head on over to our charting software, guys. Let's find them. I have this example locked down. I'm going to go over it, but I better see some from you guys. I better, because it's time. All right, we're running out of time here. Let's look at this head and shoulders on Fastly. All right, you can see right here, beautiful bullish momentum breaking up to the upside, all highs, break down, brand new all-time highs, break down, then bam, right shoulder here. Now a badass could enter at the top of that shoulder and rode the wave down, but you notice Fastly did not break the neckline, and therefore it didn't play out a full head and shoulders. This just shows you that the TA is not perfect, even with the formation going. If you're good, you catch that 3/4 portion, but it did not break our zone here, so we would have never actually entered that. Fastly again, check this out. Inverse head and shoulders perfectly here. Did not break the neckline. Very bullish pattern, but instead broke right through and continued to the downside. So a badass here would have entered at the top and would have had to have exited at the neckline there because it was a bad trade. So Fastly twice on the daily, you could see played out a head and shoulders and failed, and then played out an inverse head and shoulders and failed. Now let's see what you guys got for head and shoulders. Marcus stepping up to the plate. CVS Weekly. He said the CVS Weekly, we got an inverse. The weekly chart, you say, huh? Are we talking about this here? This is kind of low right shoulder. The shoulders don't have to be perfect. This is close. Yeah, I would call this an inverse. But this one's pretty dropped, this one. The shoulders don't have to be perfect. This one's close, Marcus. I'm not going to draw it out, but I'm not going to fault you for that one. I could definitely see it. RCL Daily. Let's check this one out. Where am I looking at? This? Let's draw this one out. Let's see. Could be. I'll tell you what, if you're a badass, there's only one way to find out, right? If we break out here and we head on out. Remember, these formations don't have to be perfect. If you're looking for perfect patterns, you're going to be here all fucking day. So if you're a badass, yeah, you could try and play this as an inverse. Once support is confirmed around this level here, you could try and play this as an inverse and the breakout. And of course, you'd want to try and break that neckline. So go for it. So let's see the TA plan out. I'm gonna leave this up and we'll see what happens. Joshua, you get a coupon, Josh. I'm sure you have never done push-up a day in your life, but you get a coupon, my friend. That's the head and shoulders. All right, let's talk about the rising and falling wedge. All right. The wedge is a price pattern marked by converging trend lines on a price chart. The two trend lines are drawn to connect the respective highs and lows of a price series over the course of, here we go, so we're back to this, 10 to 50 bars. Doesn't matter what time frame you're looking at, we now have a time period that needs to be established. The lines show that the highs and the lows are either rising or falling at different rates, giving the appearance of a wedge as the lines are approaching convergence. Wedge-shaped trend lines are considered useful indicators of a potential reversal in price action by technical analysis, all right? So a rising wedge is actually bearish and a falling wedge is very bullish. But you can see we have two converging lines sandwiching in on each other. It's a reversal of the current trend that broke into that. And the breakout is usually the opposite. So we were bearish, then we have a rising wedge, bearish, and then we have a falling wedge, and now we're bullish. Does everyone see that? Same thing as always. You would play the enter, the break of the consolidation period with a stop loss breaking back into the consolidation periods. That's how you would play a rising and falling wedge. Head on over to your charting software and find me a rising and falling wedge. And if my memory is correct, voila. Look at this, ladies and gentlemen. I'm telling you, I'm doing all the work for you tonight. You're getting off fucking easy. All right. You guys should be practicing how you want to play, though. If you want to get good at this shit, you see my charts. Every one of my charts is drawn like a fucking toddler went over them. It's because I love doing technical analysis. I love seeing the accuracy and keeping track of these plays. My best play ever was a Tesla gap up breakout, and I'll show you guys that in a second. But we have this falling wedge here, which means very bullish on Amazon, and you can see the break here. This is an easy play. Tesla or Amazon breaks at 31.30 and then brings us back to the top of the previous formation all the way at 34.31. Does everyone see that? Broke right back in to this what formation? Someone tell me what this is. Does anyone remember what this was? Looks a little different, but this was the beginning of something, into a falling wedge that broke back in, broke back out, and denied with confirmation, and that was your short entrance. You see how TA is just like reading a book almost. You can see the previous support levels, price action movement. It all comes together in one clear picture. So when you're looking at a screen like this and you're being a Monday night quarterback, or what do they call it, a Tuesday night quarterback, or whatever the fuck it is, you could see, oh man, I probably should play Amazon off those bounces from now on, or I should have played that wedge or this triangle. I mean, you start in Captain Hindsight's world, everyone's a millionaire because it looks so clean now. And that's a beautiful example of a wedge right here. That's exactly what we're looking for. Let's talk about some indicators now. I'm going to try and go over this a little bit quicker because this is a larger section, this technical analysis portion, but we should be able to get over with this in the next 20 minutes or so. We're going to talk about RSI, divergence, stochastics, and EMAs. All right, technical analysis indicators that I use and I know very well. The problem is a lot of people don't use them correctly. All right, so the relative strength index is a momentum indicator that measures the price of a stock or future relative to itself over a fixed period of time. Normally, people leave it at 21 bars on a scale of 0 to 100, and it shows the ratio between the periods that closed up and the closed down and the look back period being 21. Though 21 is the most common period for the RSI, you can change them. I believe mine's at 15, actually. I think I have mine at 15, and we'll go over there in a second. When the market picks up steam, the strength index gets closer to the top or bottom. There's always a good chance, but not perfect, because it's just an indicator that the market can retrace a little from this move. But be alert, just because it may show you overbought and oversold signals, it doesn't mean that the market can't break to newer highs or newer lows. So this is how you would trade using the RSI. All right, there's 4 ways here that we're going to use it for. You buy when the RSI comes out of oversold territory. A lot of people buy when it enters. That's incorrect. You're supposed to buy on the actual breakout. That's the buy signal because of the bullish momentum. So when you go into that extreme area, whether you have it set at 70 or 80, mine's at 80, breaking back out is the buy signal. You buy when the RSI stalls at the 50-yard line. A lot of you guys in our Discord will hear me talk about that 50-yard line all the time, how important it is. During strong markets, the RSI may not dip down to the oversold line. So a dip to that 50 or slightly below may be considered a buying opportunity if we have a stalling point at the 50-yard line. You can buy when the RSI is above the 50-yard line at any time. So instead of it being used to show overbought and oversold, if the RSI is greater than 50, then normally the momentum is still upward, and you can be considered a buying zone at any time. And then a lot of people don't know, but you can have patterns, TA patterns, in the RSIs just like a normal chart. You can draw trend lines. You can draw head and shoulders and double bottoms in RSI. I do it all the time. These are the 4 ways you're going to make money using the RSI right here. Let's head on over to our software. Let's use the RSI real quick. So there's a couple here that I probably, let me see if I have anything drawn out on these RSIs. Sometimes I put support and resistance lines up. Pretty clean right now. Must have cleared them all out. So let's just pick a random one. Let's pick Coupa Software. All right. So Coupa Software here. Let's highlight the 50-yard line for everyone. So the first one would be a breakout of, actually, I'm going to go to MasterCard. So I'm going to show you guys one of my best trades of last year, came at the end of the year, came right here in October on MasterCard. I noticed that MasterCard's RSI had dropped to just about 19. My extremes for my divergence, this is my RSI, my divergence, I have my extremes set at 80 and 20. 80 and 20 is my top and bottom lines, and my input is 14. I use the 14 right now. Sometimes I go to the 15. So one thing I noticed was the RSI dropped below 20. Then I did one of these. If you're going to do the RSI, you got to really check the RSI. So I widen it up like this, and then I zoom out. When was the last time that MasterCard's RSI dropped this low? Bang. 27th of their August 2015. So 5 years it's been since MasterCard dropped that low. That is very, very interesting to me. So I use that information as part of my puzzle. Okay. So now I know the RSI never really drops that low. You know, MasterCard's over the long period of time. That's a very bullish stock. I then charted out major support and resistance levels around, I think it was around 283 I got in. Right about here. Yep, right there, because I found this previous support and resistance level that had extreme pressures. That was at 285. I noticed the reversal intraday, and I bought MasterCard calls right here. I did my standardized swing trading method, and this was simply because of the RSI. However, I was matched by stochastic crossover, which we'll go over here shortly, and volume and a bounce off support, which was nice. I sold at 350, I think it was. Yeah, 350, just like 2 days later for about a $17,000 gain. And I was in the trade for just 2 or 3 days. And it was all because I noticed that the RSI on the daily right here had broken back into the extreme on this day. We bought in at 283. After that, bounce right at the bottom. So that's an RSI play that you can make that you always have a good shot with, especially with a company like MasterCard. One of my biggest trades ever came on Tesla with a stall at the 50-yard line. So you see how Tesla had broken into this major flag here, had broken into a huge flag on the daily, but it was having trouble really breaking down this 50-yard line. You see how we talk about stalling on the 50-yard line? Look at this consolidation period on Tesla. As it goes up and down, we have a stalling period on the 50-yard line. The breakout of this pattern matched with a breakout of the 50-yard line is a very bullish indicator. Matched with the crossover stochastics, which we're going to go over in a second. This is all very bullish momentum. This was my largest win last year, and it came from the RSI breaking above the 50 and a breakout of this pattern that I entered right here on this gap up and the gap and go at 10 o'clock. Never forget it. $77,000 later, I sold about a week later, and it was the best trade I had last year, which initially started off as a debit spread, actually, because I didn't want to spend too much money. But I quickly tossed that sell side and let it ride. So it just shows you how the TA starts matching up with other technical analysis, something like the RSI and the 50-yard line, and you'll be able to start making educated decisions much more clearly. So now let's talk about divergence. Instead of trying to outguess the market by picking tops and bottoms, use oscillators to look for divergences. Several types of divergences can be found in the markets. There's hidden divergence showing, there's levels of it. By just being aware of them and knowing how to trade with them on your side, you can get a lot more bang out of oscillators, momentum oscillators. So looking for divergences is one of the best overall ways to trade if you're using momentum oscillators, but finding one means you have to be on the alert, really looking for them. This is how you would trade a divergence right here. So a divergence occurs when the market moves one way and the indicators move another. This is the sign of a divergence, that the market may be running out of steam. So the market's going up, but your indicators are doing this. That's divergence. The second type of divergence occurs when the market is trending down and then stays pretty flat for a while, but the oscillators are moving towards the overbought level. This is a sign that the market has no momentum in the oscillator's direction and can continue its trend with force on the next wave. So if the market's flat, but the oscillators are going up, that means that eventually that divergence will play out. You'll see a large move to the upside. Normally, one looks to see when the market breaks lower and the indicator doesn't, but when the opposite happens, it's a good signal as well. An example of this is when the market is headed toward lower lows, but doesn't make a lower low, and the indicators do, as in the example I'm about to show you below. So when both the stochastics and the RSI move lower, but the stock could not break downward, in this situation, you could start looking for a change in direction or a reversal. Okay, these are very important things to look at. So let's head back to our charting software and find divergence. I use the divergence indicator right here. It just makes my life simple because it does this. You see the bearish divergence, it draws out. Now, if we go back to SPY, if you actually were a really good technical analysis, back on the March drop, you'll see this bear flag, by the way. Look at this bear flag. But you'll see the big bearish divergence leading up to SPY here. So you'll see that SPY is making new highs. You see the trend line there. And then the stochastic trend line dropped here with the extreme, broke all the way back up. But the whole time, the RSI did not make newer highs. This is a clear divergence. If you recognize this divergence on SPY on the daily, you could have jumped in 4 or 5 days prior and made one of the best trades in your career here. At the same point, if we're talking about the last bullet there on divergence, you'll notice that the market was breaking the newer lows. However, the stochastics didn't break below the extreme, And the RSI was now showing a bullish divergence because it would not break below that 20-yard line. You see that? How it was bouncing off the 20-yard line while the market was making new lows. This is the sign of a reversal. So if you see the RSI bouncing around the low extreme, 20 to 30, or bouncing around the 50, this is normally, you see the double bottom here, by the way, this is normally a sign that a reversal is going to happen. So those are ways you could look at the RSI to find divergence, or just use the divergence indicator because it's nice enough to draw it out for you. You could see this happening all the time. Look at the divergence that played out. Let's go to 15 March right here. We went from 398 to 383. $15 drop on the S&P right here, marked by a bearish divergence. When you see these divergences, it's just a good time for you to start being more cognizant of what positions, longs, leaps, shares that you're in. You know, it might be time to start moving some equity around. Divergence is just another piece of the big technical analysis puzzle. All right, and the last one or two we're going to talk about is the stochastics. This is probably one of the most widely used indicators. Most people who use it don't know what it does, how it's derived, or how to even read it accurately. That's because it's so popular, it seems to work great predicting market tops and bottoms. There's both a fast and slow stochastic indicator. The slow one is the one that generally uses the focus on this guide. The slow stochastic indicator consists of two lines. The stochastic slow is the %D and the %K. And let's go over the %D and the %K real quick. There's lots of ways to use a stochastic. Want the truth they don't tell you? The stochastic oscillator measures a market's most recent close relative to its price range over a specific period of time. The theory is that in an upward trending market, prices tend to close near their highs. And during a downward trending market, price tends to close near their lows. But as the market gains upward momentum, the closes will be at the top of the range and the indicator will be getting stronger. At the trend peaks, the indicator should be at its highest levels. Once an uptrend begins to slow, prices will tend to close further away from the high of the bar, and this will cause the indicator to fall. Even if the uptrend is still up and the market is making higher highs, it could be losing momentum if the closes are not near the highs of the period anymore. And this will be seen on the stochastics instead of the stock. Though one can use stochastics in different ways, many people have only limited understanding of how to use them. The only most novice trader way is to buy them when the stochastic indicator reaches oversold and vice versa. Though this works in choppy markets, it may not work well when one is trading against a strongly trending market like the bull market we're in right now. So since there are many subjective ways in which stochastics can be used, it can become kind of a bit of an art form to read this in many ways. So there's several ways. I'm just going to read the top line for this, and then we can come back to this here in a minute. I'm going to show you all of these. So you buy when both lines are above the oversold level and rising. You buy when the fast line K crosses over the slow line D. You're long when both lines are above the overbought area, but not yet turning lower. I'm going to show you all of that. You can buy when the indicator is strong and retests the extreme, but bounces off. You look for a failed move in the stochastics. So many times after the stochastics has been in overbought territory and topped, these lines will start to drop, but the drop appears to fail as they turn right back up. And then lastly, you can look for a divergence between price action and the stochastics indicator. Okay, so the first one, let's look when both are above the oversold level and rising. So if we look at the stochastics here, the oversold level for me is 20. So when both are above the oversold and rising, like right here, you'll see that it hasn't broken back below the oversold territory at all. It's just above and rising. And this is a sign of strength. That not at any point did it break below. Did it flatten out? So at no point was any momentum here showing. And you also could see the inverse head and shoulders here on the stochastics. So that's what it's referring to right there. You buy when the fast line crosses over the slow line. My fast line is blue. My slow line is orange. So you'll see here that when the fast line crosses back over the top of that slow line, you can make entry and ride it to the extreme of the top, which would have brought you from 376 to the top of about 393. So you can ride it like that. That's another example. You'd be long when both lines are above overbought, but not turning yet. So when we're talking about that, we're talking about they're flat right here, just like on SPY right now. SPY had reached the top on the 5th of April. However, we have no turning points. You see how it's just flat on the top of the extreme. And you can buy it at that level, which would have brought you from 400 all the way to 412. You can buy when the indicator is strong and retest the extreme. So when we refer to that, we're referring to a bounce, like right here. It bounced, retested the extreme of 80, and popped right back up. It's a very bullish sign. Conversely, it could test the bottom extreme and bounce, and that's a very bearish sign. So that's another way to read it right there. When you look for a failed move in the stochastics, so a failed move in the stochastics would be something that flattens out here. The stochastics drop. However, we are just in a consolidation period and the market rips the new highs. This is a failed stochastic movement. That failed stochastic movement will slowly be planned out over the timeline. Or you can find one like this in a little bit of chop where the K and the slow don't know what to do. They're crossing right back over each other, but eventually you find that nice flat portion. It had reached back to overbought territory. And then divergence. You can find some divergence. Let's try and find some divergence. So a divergence in the stochastics would... So here's a good one right here. So here's a bullish divergence because stochastics is bouncing off the extreme and holding. We're seeing that showing very strong weakness right here, showing bearish divergence right here. But however, the market rips to all-time highs right when it's done. So the bearish divergence did not play out, even though that I'm looking right at it. You're not going to see any strong movements, especially because it held the trend line that SPY's been in for about a year. But that's what we're looking for right there. That's not one of my favorite ones, looking for divergence in the stochastics when I have a divergence indicator. I don't recommend it, but if you can match divergences like that, you could probably find a pretty good play in the underlying assets price action. Hey, I did that for you. You guys need to wake up, all right? Lastly, we're right around the corner, team. We're rounding third. Let's talk about the EMAs. So the exponential moving average. This is a simple tool that smooths out price data. We talked about this during support and resistance. You can have a 21-day, a 50-day, 100-week, whatever the time period that the trader chooses, find the ones that work best for you. There's advantages to using the moving averages in your trading as well as options and the type of moving averages to use. Moving averages strategies are also popular and can be tailored to any time frame, suiting both long-term investors and short-term traders. So the 3 ways to use EMAs to trade is S&R. The most common applications of moving averages is to identify them as live flowing trend lines that determine support and resistance levels. The EMA crossover, where we talk about the golden cross or the death cross. That's when the 50 EMAs cross the 200, regardless of what time frame you're on. I'll show you those. These generate trading signals. And the assistance of other momentum indicators like the RSI, MACD, and stochastics. When the EMAs are matching up with these other indicators, such as like the MACD or the RSI, then we have a pretty good puzzle piece to put in here that, hey, something's starting to add up. Let's take a look. So let's head on over to our charting software real quick. So the first thing, and I went over this in support and resistance, that just shows you guys how much these EMAs, how important they are. The first thing we're going to look at is that it's used as live flowing S&R. So we can see the S&P 500 rode the 9. My purple is the 9 EMA all the way up. The blue is the 50. Rode these all the way up, a break of the 50, and we hit the 100. Oh, excuse me, that's the 21, and then this yellow line's the 50. I apologize. So this 50 EMA was acting as support right here, bouncing up and using the 21 as resistance until the next gap up day. So that's one way we can use these EMAs is their support and resistance levels. Very good for determining trends. This most recent bullish momentum on SPY, it hasn't broke the 50-yard line, the 50 EMA. So this 50 EMA is holding as true support. The 21 and the 9 have been doing a great job as well. On the opposite side, I have a personal script here, which I'm going to be releasing to the Discord soon, that all my EMAs turn red when we have a crossover. So when we go back to March here on the 15-minute, this is the crossover where the 50 EMA, my yellow, turns red and crosses under my 200. And this is your signal here. So you would enter here on that crossover and you'd ride the wave all the way down until price action breaks back above the 50. So you would exit right here, which would still lead to substantial gain. So that's your EMA crossover. And with my, this is my own script here where you can see where it makes it pretty easy to determine the crossovers because it turns bright red. So when you see a smooth flowing downtrend, like Tesla here, look at this Tesla downtrend. You enter on the crossover and you can ride this bad boy all the way down because it never broke the 50 all the way through, you see? So that's a great way to look at it. And then those golden and death crosses, you just continue that as they go. The 50 crosses back over, you can make entries. Crosses back below, you can make shorts. And then the last thing is we use these EMAs, these live flowing EMAs with our other indicators. So we just take a look and we say, okay, 9, 21, 50, 100, 200, they're all in order. 9 at the top, 200 at the bottom. So we have bullish posture. The RSI is unable to break the 50-yard line on SPY since we did gap up so massive. So overall, you know, the uptrend's looking pretty healthy. It's looking pretty strong. I would say that we're getting pretty fucking overextended at this point, but you can see how those EMAs are helping me understand that. If we use them as the next level of support on the 4 hour, we're looking at a $3 drop on the SPY. You can see that we're hitting those overbought territories on the RSI, but we're still showing that bullish stochastic pressure. All right. So use your indicators, your momentum oscillators. Now that you guys know how to completely understand them and read them, use them to give you the clear and concise picture, the bigger picture that you've been looking for in the charts. The conclusion. Many investors leverage technical analysis when making investment decisions, since technical analysis helps fill the gaps, no pun intended, no fucking pun intended, of knowledge. By developing and understanding this technical analysis, traders and investors can improve their long-term returns, but it's important to understand and practice these techniques. You have to practice how you play before committing real capital to avoid costly mistakes. Get on your trading software and chart, practice. Go back to any portion of this video that you need, hit pause, listen to me blabber for a little bit if you need it, and get to charting. Go back in there. We have those pauses specifically for your help where you can start practicing. Find out what TA strategy, technical analysis strategy works best for you. You are the trader. Everyone's different, right? What I just taught you that I use may not work for you. You may hate it. So every trader has a different style, approach, and mindset. Find out what works best for you. I just found out what works best for me, and I wanted to break the most common ones down for you guys. Practice TA like you would if you were learning another language. You can never, ever stop educating yourself in the world of trading. You must continue your education. I'm still learning to this day. You guys should do the same. And that's it. Now that you're familiar with technical analysis, we can get ready for our class tomorrow. Does anyone have any questions at all? I know that was a lot to take in. Thank you guys so much at this time. Thank you for attending day 6 of the Max Options Trading Beginner course, and we'll see you tomorrow. If you enjoyed this course, please give me a review. Say, talk too much. Say that I broke that shit down for you guys. Whatever you want. Thank you guys so much for attending. Is there any questions at all at this time? If not, have a good evening. Here's one question. I missed the whole Zoom. Can you re-say everything? Okay, Josh. Okay. And on that note, you guys have a fantastic evening.